The Trump administration's audacious plan to shift the massive federal student loan program from the Department of Education to the Small Business Administration, SBA, has sent shockwaves through the higher education and financial sectors. This controversial move, announced on March 21st, directly contradicts prior White House statements and raises serious concerns about the potential for widespread borrower defaults and significant financial mismanagement. The president's decision, seemingly impulsive given the conflicting statements from the White House press secretary just one day prior, throws the financial futures of over 42 million American student loan borrowers into jeopardy. These borrowers collectively owe a staggering $1.7 trillion, a sum that dwarfs the budgets of many nations. The inherent risks are substantial, considering that approximately 30% of borrowers were already delinquent on their payments last year. This radical shift departs significantly from earlier expectations. Many in Washington, including some Republican lawmakers, anticipated that the program would be transferred to the Treasury Department, a more logical choice given its expertise in financial management and the recommendation made by the influential Heritage Foundation's Project 2025, a blueprint that has heavily shaped the administration's policy agenda. The Treasury Department's established infrastructure and experience handling complex financial systems would have seemingly been a far more suitable landing place for such a critical program. Instead, the administration has opted for the SBA, an agency woefully unprepared for such an undertaking. The SBA's limited experience with student loans and its impending 43% workforce reduction, announced on the very same day as the loan program transfer announcement, paint a bleak picture of the program's future. The agency's restructuring, which conspicuously made no mention of the incoming student loan portfolio, only exacerbates existing concerns. The sheer scale of the task, managing millions of borrowers and trillions of dollars in debt, is beyond the SBA's current capabilities and infrastructure. This decision is particularly troubling in light of recent events. The February suspension of the Biden administration's SAVE plan, which tied monthly payments to income and family size and offered debt forgiveness for smaller loans, left many borrowers in a state of limbo. While those enrolled in SAVE are temporarily exempt from payments, the uncertainty surrounding the plan's future is a significant source of anxiety for millions. The lack of clarity and the potential for future disruptions only amplify the already precarious situation for student loan borrowers. The Department of Education, while not without its flaws, at least possessed some established infrastructure for managing the student loan program. The recent rollout of the new FAFSA form, riddled with technical meltdowns and severe delays, as reported by the New York Times, underscores the challenges inherent in managing such a complex system, even for an agency designed for the purpose. The department's difficulties are further compounded by the fact that the government dismissed at least 300 employees in March, disrupting operations and potentially delaying aid. The SBA, in contrast, is not equipped to handle the intricacies of managing student loan repayment plans, addressing borrower inquiries, and navigating the complex regulatory landscape surrounding student debt. Currently, the Department of Education contracts with companies like Mohella and Aidvantage to operate call centers and provide borrower support. The transfer to the SBA threatens to further disrupt these vital services, leaving borrowers with even fewer resources to manage their loans. The potential consequences include a surge in defaults, increased financial hardship for borrowers, and a substantial drain on taxpayer resources. The Trump administration's justification for this move remains unclear. While claims of potential cost savings have been floated, independent experts widely doubt their feasibility. The lack of a transparent and well-articulated plan, coupled with the SBA's impending workforce reduction and lack of experience, paints a picture of a hastily conceived and potentially disastrous decision with far-reaching and potentially devastating consequences for millions of American students and their families. This ill-conceived plan stands as a stark example of potentially reckless policymaking, jeopardizing the financial well-being of countless Americans and raising serious questions about the administration's commitment to responsible governance. The lack of a comprehensive strategy to mitigate the risks associated with this transfer only further deepens concerns about the potential for widespread financial hardship and systemic failure. The long-term consequences of this decision remain to be seen, but the immediate outlook is undeniably bleak for the millions of Americans burdened by student loan debt.